Welcome everyone to today's explainer. When you hear the name Johnson & Johnson, your mind probably jumps straight to Band-Aids baby shampoo and maybe a very reliable, albeit kind of stodgy dividend-paying stock, the exact kind of stock you just buy and forget about for a decade. And historically, well, you wouldn't be entirely wrong. But today, we are going to completely reframe that perspective. We're looking at a healthcare giant that is currently at a really fascinating crossroads. Johnson & Johnson is actively transforming its identity from this traditional defensive market play into a high-growth biotech innovator. And let me tell you, the broader market is paying very close attention to this shift.
Okay, let's dive right into this. A near 50% recent stock rally over the last year. Now, if we were talking about a hyper-growth tech startup, maybe that kind of momentum is just par for the course. But for a legacy healthcare company, one with a staggering 64-year streak of consecutive dividend increases, that is exceedingly rare. It signals a fundamental shift in how investors are valuing the company's future. It's really no longer just a safe haven for a conservative portfolio, it's rapidly becoming a serious growth engine.
So, to understand exactly how they are pulling this off, here is our roadmap for today's explainer. We'll start with the new Johnson & Johnson, then cover clearing the legal clouds, the innovative medicine engine, MedTech and valuation hurdles, and finally wrap up with the 2026 outlook.
Let's kick things off with Section 1, the new Johnson & Johnson, a healthcare giant in transition.
We are witnessing a complete paradigm shift for this established market player. And it's being driven from the inside out by remarkably strong operational performance across the board. And here is the absolute crown jewel of that performance. Management recently raised its guidance, and they are now setting their sights on a monumental $100 billion revenue target for the year 2026. This isn't just wishful thinking or some corporate spin. It's directly fueled by highly tangible recent results. Specifically, a stellar Q2 performance where revenue cleanly beat expectations, hitting $25.3 billion. That represents a very healthy 6.6% year-over-year increase. That kind of sturdy, reliable baseline is exactly what gives leadership the confidence to make these bold $100 billion future bets.
Moving right along to Section 2, clearing the legal clouds, de-risking the giant.
So, you might be wondering what suddenly changed to let the stock run up so aggressively. Well, $5.5 billion. That is the proposed settlement amount intended to finally resolve the vast majority of the Talc lawsuits that have honestly hung over J&J's stock for years, almost like a dark storm cloud. For a very long time, the sheer scale and the absolute uncertainty of this litigation paralyzed potential investors and kept a pretty tight lid on the stock price. The global market reaction to this number is that it's a highly positive de-risking move. Now, it is absolutely crucial to note that Johnson & Johnson firmly maintains that its talc products are completely safe. However, by stepping up and settling for an amount that was actually less than many experts expected, they are effectively removing a heavy looming overhang. The market loves certainty. Replacing a giant legal unknown with a fixed, manageable number is driving a ton of today's optimism.
That brings us to Section 3, the innovative medicine engine, navigating lost exclusivity.
To really understand J&J today, you have to look at how they're handling the lost exclusivity of their former blockbuster drug, Stelara. They are absolutely not standing still. They are actively replacing it with a powerful new arsenal. Let's just take 3 stars of this new pipeline as an example. First up, we have Carvykti, a multiple myeloma cell therapy that's rapidly gaining significant market share in the oncology space. Next is Icotyde. This is a revolutionary once-a-day oral pill for plaque psoriasis that has an unbelievable peak sales potential of $10 billion, all on its own. Finally, Imidavi, for generalized myasthenia gravis. Management actually refers to this one as a pipeline in a product, meaning it could potentially treat multiple autoimmune diseases effectively. And honestly, here's the craziest part. This is just the tip of the iceberg. Management firmly believes they have 10 new products that could each hit $5 billion or more in peak sales. That is a truly formidable lineup of innovation. But we need to stay objective here. Let's look at Section 4, MedTech and valuation hurdles, the reality check.
As much as we all love a great growth story, a complete analysis absolutely requires looking at the bear case. While pharmaceuticals, that innovative medicine segment we literally just discussed, soared with an impressive 7.8% growth in Q2, the MedTech division grew by only 4.5%. This clearly demonstrates what analysts are currently calling a soft patch in their medical technology wing. It's undeniably acting as a bit of a drag on their overall growth average.
So, what exactly is causing this soft patch? Let's stay grounded and detail the specific headwinds here, which are primarily located in their cardiovascular unit. First off, Abiomed sales actually declined by 2% in the quarter. Second, there's significant caution right now surrounding the Impella heart pump. Some recent clinical trials raised questions, leading doctors to take a much more cautious approach, and this headwind is expected to persist until new clinical data comes out in 2027. Add to that the ongoing intense pricing pressure from the Chinese government's volume-based procurement program, and you can easily see why MedTech is lagging. For investors, the takeaway here is that MedTech will likely act as an anchor on overall margins until at least 2027. So, that brings us to the absolutely crucial question. Is all this good news we talked about earlier already priced into the stock? There is deep tension in J&J's current valuation. On one hand, a discounted cash flow model, which just looks at raw future cash generation, suggests the stock is roughly 28% undervalued. That implies a significant discount. But then on the other hand, the PE ratio is sitting at roughly 30x. That is a stark premium compared to the broader pharmaceutical industry average of just 16.6x. This means investors today are paying a very high price up front for that expected future growth and stability.
Which leads us to our last stop today, Section 5, the 2026 Outlook, the final verdict.
Where does all of this competing data actually leave us as we look toward that monumental 2026 revenue goal? Well, when you poll the experts, the consensus rating remains a very solid buy. The average one-year target price sits at around $272.50, representing about a 5% upside from current levels. But what's really compelling to see is that top-tier firms, we are talking Citi, Goldman Sachs, and Morgan Stanley, have individual targets reaching up to $305. It shows broad institutional confidence that Johnson & Johnson is going to successfully execute this incredible fusion, maintaining the defensive, cash flow reliability of a 64-year dividend aristocrat while simultaneously unlocking the explosive growth of a true biotech innovator.
Which brings us to our final, somewhat provocative question for you to consider today. Does the 2026 vision justify the premium price? You've seen the powerful legal catalysts, that massive $100 billion target, and the genuinely incredible new drug pipeline. But you've also seen the very real valuation hurdles and the MedTech soft patch. As this giant transforms right before our eyes, it's really up to you to weigh the evidence. Thanks so much for joining me for this explainer, and we'll see you next time.